the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant.
Well, we are starting to see the consequences of the buildings don't go away.
The housing market has hit the brakes after 2 years of skyrocketing home sales and surging prices. The culprit? Mortgage interest rates, which have shot up dramatically. It all began in March 2022, when the 30-year fixed-rate mortgage exceeded 4%, and by October of the same year, it reached a staggering 20-year high of 7%. While it has since leveled off a bit, it's still hovering in the mid-6% range, significantly higher than what we've seen in the past. This surge in interest rates has sent home prices on a downward spiral, raising serious concerns. With interest rates now more than double what they were just a few years ago and fewer buyers in the market, is this the early warning sign of a major housing market crash? The signs are pointing to a significant downturn, and some experts even argue that it might be worse than what we witnessed in the 2008 financial crisis. In this video, we'll delve into the historical context and economic indicators that suggest the impending house market disaster could be even worse than the 2008 crisis. So let's jump right in. So, let's roll back to March 2022, when things were pretty calm in the housing market. But out of nowhere, mortgage interest rates started climbing at breakneck speed. The trusty 30-year fixed-rate mortgage, a favorite for stability, suddenly shot past 4%. And brace yourselves, because it didn't stop there. By October of the same year, it hit an astonishing 7%. Yeah, you heard that correctly. 7% for a 30-year fixed-rate mortgage. Now what's the impact of these high interest rates, you might ask? Well, it's pretty simple. When it becomes more expensive to borrow money for your dream home, buyers start to rethink their choices. Home prices, once on a rocket ship to the moon, began to cool off. We've seen a lot of people getting priced out of the market, and it's not hard to see why. Over the past 30 years, we've witnessed a significant decline in interest rates, and it's been a game changer. Historically, interest rates were much higher than they are today, but as the years rolled on, we saw a steady decrease in rates, creating the conditions necessary for the formation and eventual collapse of the 2008 financial crisis. However, here's the kicker. After the 2008 crisis, the Federal Reserve continued to push rates to new historic lows, bringing them down to just 2.6%. Alright, let's break it down. Imagine this. One year, a bunch of cozy 2 or 3 bedroom houses hit the market, and the next year, it's all about grand 6 or 7 bedroom estates with sprawling lawns. If you just compare the median prices of homes sold in these different years, it might seem like the housing prices shot up, when in reality, it's just a shift in the types of homes being sold. The CaseShiller approach, developed by economists Carl Chase and Robert Shiller, prevents this misleading comparison. It requires 2 transactions for the same house, focusing on measuring the change in prices for homes that sold in one period to the prices of the same homes when they last changed owners. Now you might be thinking, okay, but what does all of this have to do with the housing market? Well, here's the twist. It has everything to do with it. When people talk about buying a house in 2000 for $100,000, it might seem like a sweet deal, but we've got to adjust for inflation. That $100,000 in 2000 is worth about $178,000 today, which is an 80% increase. And that's why we need to adjust for inflation when we're talking about home prices. To do that, we can use the inflation-adjusted CaseShiller chart, which paints a more accurate picture of real home prices. One of the most significant early warning signs is the decline in home prices. It's been making a lot of folks, including experts, pretty darn nervous. You see, when we talk about declining home prices, it's not just a small dip we're dealing with. We're talking about a drop in prices that's really caught everyone's attention. Now, let's do a quick flashback to 2008 for a moment, a year many of us would like to forget. During the Great Recession, we saw home prices taking a nosedive, and it wasn't a pretty sight. But here's the kicker. The CaseShiller Price Index, which is like our real estate weatherman, is telling us that the National Housing Index has already fallen by about 2.2% this year. And you might think, well, 2.2% isn't that big of a deal, right? Well, you're right. But there's a twist to this story. What's making experts raise their eyebrows is not just the percentage, but the alarming rate at which this decline is happening. But wait, there's more. The plot thickens when you consider the potential risks in the housing market right now. I'm talking about the sharp descent in home prices, the soaring mortgage rates, and a shrinking pool of potential buyers. Picture this. Interest rates have more than doubled compared to just a couple of years ago. Now that's no small feat. And in a market where affordability is key, this spells trouble. When you have people who can't afford to buy and existing homeowners seeing their property values decline, you've got a recipe for uncertainty, to say the least. So what should we be concerned about? It's not just that we're seeing a drop in home prices, it's the rapidity of the fall that's turning heads. And the more it crumbles, the more it starts to look like the housing market we thought was stable is actually perched on a precipice. The real danger is the potential for a housing market crash. Think about it. During the last recession, one of the major culprits was the behavior of interest rates. We're currently witnessing a staggering number of homes under construction in the US, with a whopping 1.7 million properties in the pipeline. However, the big question is whether we have a demand that matches the supply. Now let's rewind to 2006, a time when the US experienced an explosive population growth of nearly 3 million people annually. It was like a population explosion, and the real estate market was bustling to meet the demand. Fast forward to today, and we're dealing with a different scenario. Our population growth has notably slowed down, estimated at around 500,000 to 1 million new residents annually. You see, our world is evolving, and so are our housing needs. It's not just about the number of people, it's about the kind of homes we require. With the changing times, we now need different types of homes that match our lifestyles. But here's the catch. Even with slowing population growth, the construction of new homes is soaring. So you might wonder who's going to be interested in buying all these homes? That's the million-dollar question. We've got a situation where there's a mismatch between the number of new homes being built and the actual demand. In recent years, there's been a noticeable trend, a boom in the construction and development of luxury properties, particularly in major cities. It's like a luxury property frenzy. And the result? An oversupply of these high-end homes that developers expected to fetch top dollar. But here's where things get interesting. When you have an oversupply, it can become incredibly challenging for developers to sell these properties at the inflated prices they were banking on. Now, let's talk about the consequences. When these property values start to decrease and buyers can't afford the luxury price tags, we've left with a scenario that could spell trouble. You see, when property values plummet, it can lead to more defaults on loans taken out for these luxury homes. Defaults mean people can't pay off their mortgages, and that's when the domino effect kicks in. It's a chain reaction that could potentially bring down property values even further, leading to another housing market crisis. One critical aspect we can't overlook is the return of risky lending practices and those notorious subprime mortgages. Now, we've seen history repeat itself, and not necessarily in a good way. Lending standards were loosened to help revive the housing market post-2008, and as a result, subprime mortgages made a comeback. And what's really unsettling is the mounting mortgage debt. It's like a ticking time bomb in the housing market. A growing number of borrowers are holding levels of debt relative to their income that are, well, pretty darn high. Now let's talk about the Fed's role in this looming crisis. The Federal Reserve has been trying to raise interest rates in an attempt to control potential inflation. But here's the problem. The bond market isn't exactly playing along. This is where it gets really concerning. Investors seem to be worried that serious inflation might be knocking on our door. How do we know this? Just look at the 10-year Treasury yield. It's been steadily rising since early 2021, indicating that investors want higher returns to protect themselves from potential inflation. The 30-year yield, essentially the same as the 10-year, tells us that something much bigger is going on. The fear of inflation, which could severely impact the housing market and potentially trigger a crash, is looming large. So, let's wrap it up. The housing market crisis is not a distant threat, it's imminent. When we add up all these elements, it's like watching a house of cards slowly crumble. The crisis we're facing today could surpass the 2008 housing crash, and it's time to prepare for the storm. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.